After a difficult year for equities, many investors are reassessing how much risk they can realistically take. They are not exiting markets entirely, and they are not chasing sharp rallies either. Instead, many are looking for a middle path. That is where balanced advantage funds come in. So what are these funds? And why are moderate risk investors considering them as a strategy for 2026? Let's break it down after a quick break. Balanced advantage funds, also called dynamic asset allocation funds, aim to strike a balance, participate in equity upside while limiting downside risk. In 2025, when equity markets struggled, this category stood out. On average, balanced advantage funds delivered returns of over 5%. Compare that with other categories. Flexi-cap funds returned around 3.6%, mid-caps about 2.4%, and small caps ended the year in the red. Investor behavior reflects that shift. By end December 2025, there were 35 balanced advantage funds in the market. Together, they managed assets worth roughly 3.23 trillion rupees. And in 2025, these funds saw net inflows of over 16,500 crore rupees. Balanced advantage funds invest across both equities and debt. The key difference lies in how they decide the mix. Fund managers typically rely on internal models and market signals. When valuations look stretched, equity exposure is trimmed. When markets correct or valuations turn more attractive, equity exposure is increased. Some funds follow a counter-cyclical approach, adding equity when markets fall. Others are more trend-following, increasing equity exposure during rallies. Now, one reason investors rely on these funds is their long-term performance during volatile phases. Over the last 10 years, calendar year returns for balanced advantage funds have not turned negative as a category. That does not mean returns are always high. It means losses are often contained. There is, however, a trade-off. In sharp market rallies, balanced advantage funds can lag because they deliberately cap equity exposure. In strong years like 2023 and 2024, these funds delivered solid returns, but still lower than pure equity funds. It's also important to be clear, these funds are not risk-free. Short-term returns can turn negative. The debt portion carries both interest rate risk and credit risk. And because these funds are actively managed, costs are typically higher than passive options. So who are these funds best suited for? Moderate risk investors with a 3 to 5 year horizon who want equity participation without extreme volatility. For many retail investors, allocating 10 to 30% of their portfolio to these funds can make sense, depending on risk appetite and overall goals. Follow for more such market explainers.